Everyone, today on the final bar, we'll do our normal Monday routine. We'll hit the market from three directions: top down macro, bottom up stock picking, sector rotation. We'll talk about the big picture, this distribution mode. We talked about much of the last couple of weeks, continuing today with the S&P, the NASDAQ continuing to push lower. We'll also touch on some of the other asset classes like oil breaking to new highs. We'll look at some of the sectors that are working and some of the individual stocks on the move. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the charts. We look at how the markets have evolved every trading day, focus as much as we can, or relate the short-term movements that we recognize every day, connect that to the longer term. Some of my guests last week, it was really cool. Guys like Dana Lyons and others talking about really the long-term trajectory of markets. Jeff Weiss on Thursday had some really good long-term trend lines, which actually are in play today. If I remember right, 4,300 was sort of that short-term support level we were talking about with Jeff last week. So really interesting connecting the short-term distribution that we've been reviewing with the long-term trends and how they are actually playing out. Interesting when I was doing my review over the weekend and into today, preparing for the show, looking at some of the previous leadership stocks that are rotating lower, some of the FANG stocks like Facebook and Microsoft and others that are kind of rotating lower, but also other names in healthcare and technology that have had these long-term uptrends all coming under pressure. If you look at the chart of the energy sector, the average stock in there, pretty decent breakouts. A lot of emerging relative strength in places like consumer staples, places you probably not thought about in quite some while. So we have a lot of charts to review and try to make sense of. We have some great guests on the I mentioned some of them last week, which were really, really good. This week, tomorrow on Tuesday, we have Craig Johnson, technical analyst at Piper Sandler in Minneapolis. I did needle him in advance on social media because my Browns beat his Vikings this weekend. So perfect that he is joining the show this week. The end of this week, I'm actually taking a vacation with the family. So we have a guest host on Thursday. That's Julius DeKempener, founder of RRG Research. And then on Friday, Tom Boley, chief market strategist at earningsbeats.com. The show will be in good hands. They're both exceptionally talented analysts and strategists. So it'd be great to get their perspective on what's happening here. And I'll be back with you live on Monday. Next Tuesday, the 12th, we have Ari Wald from Oppenheimer. We also, I will be speaking at the Money Show. They're doing a virtual expo this week, October 5th through 7th. I will be speaking on October 5th tomorrow at 2:40 p.m. Eastern. I'll be doing a presentation called Behavioral Finance, How to Avoid Confirmation Bias. Confirmation bias, I would argue, is one of the most widespread behavioral biases. This is where you mess up and you develop your decision first, and then you start gathering information. And we will talk about some of the ways you can reverse that. Focus on the charts, focus on the evidence, and then draw your conclusions afterwards. For more info on that event, go to stockcharts.com/money show. Let's continue on with today's market recap. So as I mentioned earlier, the show has three parts: the macro perspective, the sector rotation, and then stock picking. And really this, in less than 30 minutes, summarizes some of the takeaways that I find in my own weekly process of going through each of those areas and focusing with a great amount of detail on some of the charts here. So this bubble to the top as I was reviewing some of the charts this weekend and into this morning. So the S&P to start off with, down 1.3%. NASDAQ really pushing the way lower, down over 2%. The mid cap and small cap index all down as well, but less than the S&P. So this was small over large on a relative basis. That ratio of small versus large continuing to favor small caps here as they have recently. Is sort of that theme of mega cap leadership has been changing. The VIX, by the way, back up, nearing the 23 point. Saw on Friday, and the 10-year yield settling in around 148. The long bond ETF that we follow, TLT, was down about 1/4%. The dollar as well, down about 1/3%. Commodities continuing a period of strength, and energy prices all pushing higher today. Energy, the number one sector out of the S&P, one of two sectors that did just fine today. We'll touch on that here in a few moments. But if you've talked about the commodity super cycle, this reinvigorated price behavior from the commodity complex, days like today certainly validating that overall thesis. Mixed bag of sorts in cryptocurrency land, with Bitcoin actually pushing to the upside over the last couple hours and nearing back to that 50,000 level. We'll try to touch on that chart here in a few moments if we can. And then just very quickly, we'll talk a little bit more about sectors later, but I think it's worth noting today in terms of key takeaways from today's session. Energy up fairly significantly, utilities number two. Everything else was flat to down, with communication services and technology pushing the majority of the way lower. Those are the outliers on the downside. So you sort of had the haves and the have-nots today. A couple sectors up fairly well, a couple sectors down pretty well, and then everything else sort of in the mix in the middle. As we look at a chart of the S&P 500, we looked on Friday at this chart and how it's rotated, I would argue, from a period of accumulation to a period of distribution. And the question, as always, is what's the time frame, right? And I was asked on an interview earlier today, so, what's your outlook on stocks in so many words? And my answer was, well, it depends very much on your time frame. If you're thinking more tactically, if you're thinking more short term, I'm seeing plenty of signs of weakness. I would say that the S&P 500, there are a number of things that have changed in the last month that have finally demonstrated the weakness I think many of us have been perceiving as potentially coming. And it's the RSI rotating from a bullish phase remaining above 40 to a bearish phase remaining below 60. So it's actually remained 50 for most of the month of September into the beginning of October here. We've gone from a pattern of higher highs to lower highs, a pattern of higher lows to lower lows. We've broken support. We've broken the 50-day moving average, testing it from above and rolling over. All of those things that I just mentioned validate the fact that we're in a short-term distribution mode. And as a trend follower, it's sort of time frame agnostic, right? I mean, when is the trend over? Well, when the trend stops going down. And I say that oversimplistically, but with good reason. I think that is the goal of the trend followers, to recognize that the trends have changed. We'll bring up a series of charts later, a lot of individual names that had been some of the top performers, all rotating lower. And the question is, of course, how much do we come down, right? So far, we've gone down about 6% off the all-time highs about a month ago, early September. I have sort of some lightly shaded potential downside targets just to show what that would look like. A 10% drop from the all-time high would take us just below 4,100. That would take us down to the May low, which was one of the times we tested the 50-day moving average. That would also put us within a rounding error of the 200-day moving average, also the 38.2% retracement level, around 40.35. So given what we've seen, that would actually be a fairly reasonable downside target and sort of end in the 40.50 to 41.50 range. I could very much buy into that as a legitimate downside target. And if you're bullish on the long term, that could be an ideal entry point to ride this next leg higher. That's enough of a shakedown. You'll see a lot of the stocks pulling back to key support levels. You'll find stocks testing Fibonacci support levels, just like the S&P would be in that scenario, and that gives you a good potential opportunity to ride the next leg higher. If that would fail, though, and I think getting below 40.30 or so, which would take us below that first Fibonacci level, then you have to really think about downside deterioration and recognize that a lot of the charts you would be holding or you'd be looking at have really gotten away from a bullish phase into a bearish phase. The S&P gets below its 200-day moving average. That is a very different look that we've had. That would be the first time since back in early 2020 when you had the February to March sell-off. That would certainly be a more severe pullback than we've seen in quite a while. Interesting, by the way, I was reviewing this over the weekend, and I couldn't help but notice January, you had a bearish momentum divergence, brief pullback, continuation higher. April, you had a bearish divergence, brief pullback, continuation higher. July, the same exact thing, bearish divergence, very brief pullback, rotation higher. This was literally one time where you did not have a bearish divergence. We never became overbought since early July, actually. So August, September, when we made new highs, the RSI never became overbought. So you really didn't get a bearish divergence. So these three times we did have the bearish divergence, the market resolved higher. The one time we did not have a bearish divergence, that's when the market really sells off more significantly. And that's why something like a bearish divergence is not a 100% holy grail type of indicator. It just tells you about the conditions. At the end of the day, it's all about price and breakdown. That's why every one of those times we talked about, do we hold the 50-day? Do we hold support? Every time we did. Now's the time when we didn't. So overall, I'm very much seeing a move toward the defensive side of the ledger. If you look at the NASDAQ 100, again, it's a short term, I would argue, head and shoulders pattern. That is a high surrounded by lower highs. We broken the neckline. That's pretty classic. It's a little shorter term time frame than I might ideally want to see, but overall, I think it plays the part. However, you have to remember that the height of the pattern tells you the potential downside objective. So, given the height of that pattern, that only gives you a minimum downside objective to around 15,000. That's not too far below where we're at right now. Now, on the Nasdaq, you had a very big bearish momentum divergence, higher highs July into September, lower peaks in momentum, and certainly you're seeing the leadership change from some of the Nasdaq overweight sectors. We'll review that in a few moments here. I just want to finish off looking at one more, the New York Composite. We don't look at the NYSE Composite Index too much, but I think it's worth noting because there's a really compelling support level here. When we talk about what differentiates a short-term pullback with a steeper, more significant pullback, it's worth noting that the NYSE Composite Index has been in a bearish mode based on its momentum for a number of months. It really hasn't been continuing higher in August, September, along with the other indexes we've been talking about. And there's a very significant support level around 16,000 or so. These are the lows for May, June, July, September, and that would be the 200-day moving average as well. Breaking below 16,000 on the New York Composite Index could be a real compelling breakdown to tell you about further downside potential for stocks. We need to continue on. So we've talked about the big picture, about overall, this rotation from positive to negative for a lot of the benchmark indexes. And again, I think the weight of the evidence is more negative there for a lot of reasons, but mainly the breakdowns that we've been reviewing. Until you see some signs of accumulation, certainly feels like the path of least resistance is down. Let's talk about sector rotation and some of the sector indications that we can tease out. We'll start with the RRG. This is the relative rotation graph. And again, I'm really happy Julius de Kempener agreed to host this show. He'll be in on Thursday, so I'm sure he will be sharing probably more details on the using the RRG rotation, asset rotation than we normally have a chance to get to. So check that out for sure if you can. But overall, we're looking at the 11 S&P sectors, how they're rotating around the benchmark, which are the crosshairs there in the middle of the chart. In general, things move in a clockwise direction. You can see when things are sort of in this blue shaded color heading northeast, that means they're in the improving quadrant, and they're improving not only in where they're at on the relative strength, but also the direction of improvement, meaning the momentum is actually improving as well. So two sectors really fit that bill: improving quadrant with improving price behavior, and it's financials and it's energy. And this is using weekly data, so it's a little more of a longer term look. But look at energy has rotated from a severe position. I mean, the ultimate lagging sector. This was far to the left, now rotating back, heading northeast, the direction of improvement in the improving quadrant. Financials as well, both sort of popping up here. Utilities maybe the third, and consumer discretionary is a stretch, but those are the others that I would recognize. What's rotating more weekly? It's real estate, it's technology, which is now in the weakening quadrant, and it's healthcare. And when I'm looking at the healthcare sector, I don't know how much we'll be able to get to in our next segment, but a lot of breakdowns in the healthcare sector. Biotech has been relatively challenged, but continuing to go down. But a lot of the previous leadership names, stocks like Danaher and Mettler Toledo and ResMed and Waters Corp and West, all sort of breaking down, have had nice runs, but they're all rolling over. And again, the question is, do short-term losses become long-term losses, right? Do small losses become large losses? And the way you do that is by defining your risk, defining at what level or what move that would tell you to revisit some of those previous leadership names that are now under pressure. Looking at the 11 S&P sectors sort of from a top-down view, this is using the candle glance function. This is one of my favorite ways on StockCharts to take a group of things, whether it's a group of ETFs, a group of holdings, a brokerage account, a client account, even just industry sectors, the Dow. These are most of the tabs you have at the top of the screen are all candle glance pages like this, because I love looking at all of these charts together. You're sort of starting at the top level, and then figuring what charts you need to zoom into. And I mirror this. This is based off of what we used to do at the Fidelity chart room. You had all these charts on the wall, and you could take a few steps back, kind of look at everything, and then just see what jumped out at you, what breakouts and breakdowns draw you in. And what is really telling to me, the way that I have my candle glance page set up here, is look at communication services in the upper left, look at energy in the sort of middle left. At how these two are almost inverse of each other, right? You have communication services, consistent, strong performer, consistently above its 50-day moving average, gapping below the 50-day and rotating, making new swing lows. Energy, you have the opposite. You have a breakdown or a downtrend, making new highs in June, and then that was it. Retesting the 200-day moving average, now breaking above a 3-month base, breaking to new highs, gapping higher, and now pushing through and testing all-time highs. Let's look at both of these charts in a little more detail. So, the XLC looks like a lot of the leadership names. This looks like the chart of Facebook and Microsoft, a lot of the healthcare names I just mentioned, some of the technology leadership names like, I don't know, MPWR, Cadence, Fortinet, Intuit. These are all similar charts that have just been nice, long and strong up and to the right charts that are now rolling over, breaking their 50-day, breaking previous swing lows, and now in a position of relative weakness. Now, communication services has essentially been the market, right? This has been the chart of the overall S&P, and the fact that you've gapped below the 50-day, unable to reclaim it, I think that tells you all you need to know about the at least the short-term trend of some of these things. And the question is, how much do we retrace between these lows? And I think, as what I often recommend to people, or usually recommend to people, is start at the final bar, which is one of the reasons why this show has that name, because it's always important to start with the final bar, the current bar, the most recent bar, and then look to the left. That's how you should be analyzing things. A lot of people kind of incorrectly, I think, start at the left and sort of follow the trend in the price and then see where we're at. I always tell people, start where we're at and then look where we're at relative to where we've been. And that tells you some of the conditions that we've been in. You can see simply where we're at relative to the moving averages, some of the general sense of long-term and short-term trends. Now compare that chart to energy, and you can see why charts like DVN are breaking to new highs, ConocoPhillips, some of these other stocks that hopefully we'll have a chance to view after the break, all rotating higher. The XLE has been essentially range bound for quite a while, right? If you look at the rally into March, from there it's been a sideways trend. Although you made new swing highs and you even made new swing lows to a degree, overall it's been a sideways move, and that has caused the sector to underperform pretty significantly. In the last 6 to 8 weeks, you've seen quite a rotation. It went from testing the 200-day, breaking below price support, failed breakdown, and actually rotated right back higher, broke to new swing highs, back above the 50-day moving average. Now we're testing the new highs for the year. A lot of individual names I mentioned, some of the charts like DVN, have already broken to new highs. After the break, we'll look at some of those in a little more detail. So you're seeing, when you look at the sectors, rotation away from some of the previous leadership, a rotation into some of the things that had not been doing well, which is pretty classic for the end of a bull market phase. We're going to take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller at StockCharts.com. Thanks for joining us every weekday after the close as we focus on the charts together, using the power of stock charts to visualize investor behavior and understand trends, price momentum. A couple comments before we get to our next segment. Number one, we would love to hear from you. Feedback on our show, always welcome. Feedback on your hosts, our guests, all the people that we're bringing through and sharing with you, but especially questions that are coming up as you are analyzing your own charts, questions on technical indicators, on particular charts or ratios, ETFs, market history, market dynamics, whatever it is. We'd love to answer your questions. The best way is email thefinalbar@stockcharts.com. We're also on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video you're watching on our YouTube channel. We would love to get your questions. Hope to answer one of yours on Tuesday's show in our next mailbag segment. Also, go to stockchartstv.com. You can use your email address, set up a free account, start watching all of our great content immediately from their website. Also, from your mobile devices, great special events like The Pitch, our mid-year market outlook, our newly relaunched Chartwise Women, which was fantastic last week, and many, many more great shows and great content. Go to stockchartstv.com or search on any of your mobile devices on the app stores, Stock Charts TV on demand. Let's continue on with our next segment, Shifting Stocks. And now this completes our three-pronged approach to understanding the markets using the charts. We started with the big picture, the short-term deterioration in the S&P, potential downside targets given further distribution. We talked about sectors and how some of the previous leadership sectors like communication services struggling, some of the more value-oriented cyclical sectors that hadn't been underperforming starting to show signs of life, like energy, financials as well. Now let's look at some of the individual names. I think I would bucket this discussion, and we'll see how many I can get to, in sort of four buckets of stocks that I would be aware of or be following this week. The one would be the FANG stocks, right? The FANG man names, and we're looking at Microsoft here, but we can look at a couple of them. on my member dashboard, and I would encourage you in the upper right of your dashboard, these little gears, make sure you pick like additional data panels, chart list panels, and especially chart list panels. Because what I did was I basically made a chart list with what I call the fan mag stocks: Facebook, Amazon, Netflix, Microsoft, Apple, Google, or Alphabet. Put all six of those in the fan mag or the FANG Plus index on here, so you can see during the day how the market is doing and focus on some of those leadership names. If there's a group or a list of stocks you're trying to focus on and just pay attention to, this is a really good way to use the dashboard, and you get all of it all on the same page. So looking at that, clearly you can see a lot of these underperforming today and pushing the market lower, really leading the way lower. And again, these are mega cap stocks with huge weights in the S&P and the major averages. So the indexes are going to be down most likely if these stocks are struggling, which they certainly are doing today. So if we look at some of these individual names like Microsoft, over the long term, is this a broken chart? Not really, right? I mean, overall, you can still we're still arguably making, we're not too far of new all-time highs. The trend overall has been very constructive. We're down a little bit on a relative basis, but not horribly. So again, there's not been a ton of damage. We're down from 305, 310 down to around 280. And again, that's a move, but it's not the end of the world type of move. However, the thing to remember is focusing on where, if you're holding a stock like Microsoft, where you decide that it's no longer worth your attention, right? When stocks like this start to not work and other stocks are actually performing much better, at what point do you start lightening up on charts like this and layering into some of the charts that are working better, things that we mentioned earlier that are starting to emerge and so show some renewed signs of strength. For the chart of Microsoft, there's no doubt in the short term we've felt the pain. We've broken down through the 50-day. We've gone from a pattern of higher highs, and I think its inability in September to eclipse August's high was significant. Most months this year, we've been able to make new all-time highs. This is sort of a stable period, starting to rotate lower a little bit. You saw similar pullbacks in March. You saw similar pullback in May. And I think at this point, we've done a very similar pullback to those previous ones. We make new all-time highs. We stabilize for a couple weeks. We gap down and pull back a little bit. Same thing April, May before we made new highs in June. This would be August, September before we make new highs in October, if that pattern's going to continue. The question is, are we able to establish a higher low? We're find some sort of support. And at this point, it's not really happening yet, right? We're continuing to see some short-term distribution. The good thing about this is if you look down, there's some clear support levels. 257, 260 would be the 200-day moving average. That's certainly a level I would be keying in on. The lows from May and June, absolutely the case. And I will tell you, we've talked about Fibonacci retracements with some stocks, but I think with a lot of names that are sort of in distribution mode, this is a really time to lay those on here. So here what we're doing is saying, if the low in May of 2020 was the beginning, and if the high in August, September of 2021 was the end of this uptrend, and we're retracing between those extremes, where might I expect support? It's interesting on a chart like Microsoft, around 240 lines up with the May low. That lines up with the February high. That would be a very reasonable place for the price to find support, the chart to find support. Again, that's quite a move. That's from 280 down to 240. That's another 15, 20% a haircut from where we're at right now. That could be what's in store before all of this is said and done. Keeping eyes on those and thinking about that potential downside risk, what your portfolio might look like if you're holding those sorts of names is pretty important. Facebook obviously under a lot of pressure this week and after the weekend, with a lot of negativity in recent weeks about data and so forth and their overall strategy. And again, I'm reminded of the benefits of charts. You don't need to know what's going on with Facebook as a technical analyst. The chart tells you that things are wrong. I'm reminded, one of the examples we always used to use was Krispy Kreme donuts. The chart years ago, and this is like mid 2000s, the chart started to roll over and continue to push lower. And the reasons why that was happening, the fact that the management team was messing up a lot of things and the company was in really difficult situation. That did not become clear until quarters later when the earnings started to really deteriorate. They had to restate earnings a number of times, but the chart told you that something was right. So you're seeing that price behavior in Facebook. This is a stock that's consistently remained above its 50-day moving average. That's now failing. It's very near to its 200-day moving average. I would be focused on that and seeing if it's doing it. But Facebook is now oversold, and the relative strength is really coming off after a period of certainly performing very well. So that first bucket are those names like Microsoft and Facebook that have been the leadership, and mega cap names struggling is not a good sign for the market overall. You also have a whole bucket of stocks. I think the second one are these leadership stocks like Costco that have been really good performers that are now also to break down. So they've been outperforming on the way up, many of them underperforming on the way down. Costco is actually holding up there on a relative basis, which is why an important chart to watch to see how far some of these things are actually starting to decline. We talk about bearish divergences, certainly seeing a bearish momentum divergence here in the last 2 months with August, September highs met with lower momentum on every push higher. But a bunch of stocks that I put in there, like within the financial sector, it's this group with specialty finance, MSCI, Moody's, S&P Global. Within healthcare, you have things like what would I put? Like West, WST, West Pharmaceuticals, these kind of names. Again, not charts are not horrible yet, but they're certainly coming off and no longer making new all-time highs. What concerns me about some of these charts is the fact that they're underperforming so much, and it raises the question: what's actually outperforming? And that would be that third bucket that I would be focusing on. Charts like Devon Energy, DN, this is one we've highlighted recently, sort of a nice basing pattern, hitting resistance in June, rotating lower, bouncing back up, testing the highs, powering through the upside, relative strength, making new 12-month plus relative highs. There are a lot of charts in the energy sector, as you can probably guess, making new highs, making all-time highs and or new swing highs, but all with improving relative strength. And I think that's a great bucket to pay attention to. The final one, and sorry, I'm blowing through some of these as quickly as I can. I think it would be consumer staples names, charts that are having improving relative strength. You know, ADM is on a price basis. It's not my favorite chart of all time. I mean, it's okay, and it's actually holding up all right, but it's had a nice pullback. Now it's bumping up against resistance around 62, 63. If it can get above there, look at how the relative strength is making a new 3-month high. ADM fits into that bucket. SYSCO, SYY is another one. These are charts kind of making nice sort of rotations higher. Relative strength has gone from consistently down to starting to break out. Those charts continue to go higher. It tells you that people are getting defensive and they're parking in the really scary, boring stuff just to ride some of this market uncertainty out. So I'd be looking at each of those 4 buckets separately, put them all together, and you'll have a good sense of what's happening in equity land. To wrap the show, go to 3 in 3 charts in 3 minutes. Here we go. Chart number 1 is a chart I probably need to rename. I call it a risk on, risk off chart. And the only reason I need to rename it is because it hasn't really been a good measure of risk on, risk off, but it has been a great way to illustrate the dynamic of this market. Some of the basic ways you would think about risk on versus risk off, right? Are investors going more risky or less risky in their positioning? The relative performance of small caps is one of the classic ways to do that. Equal weighted S&P versus the cap weighted S&P, meaning are people getting the smaller end of the S&P? Those are 2 classic ways to do it. These, both of these have been in a pretty consistent downtrend for the last 6 months. Both of them peaked in March in terms of the Russell 2000 relative ratio, in June for the equal weighted S&P to cap weighted S&P ratio. They've been going down since then. But look at how in the last 6 weeks they're all starting to rotate higher. They're both making new highs or new relative highs for this ratio. It shows you that it's actually not been showing you risk off. It's just been showing you leadership. This has been about a question of mega cap leadership, now rotating to some of these smaller stocks. And it's particularly in sectors like energy, financials, materials. These are the sectors that are a little more weighted in some of those indexes. Chart number 2 is the USO, the U.S. Oil Fund. A lot of times commodity ETFs become disconnected on a performance basis from their underlying or from their underlying commodity or future, and it's just the way that they have to get that exposure and all of that. The USO is actually kept with the crude oil future pretty consistently year to date, and both of them making new swing highs. The USO is up over 2% today. You can see this basing pattern: July, August, September, now rotating above, making a new swing high, testing that previous breakout level, and now again gapping higher and making a new up. That is why the energy sector has been leading. I see further upside potential for sure in the commodity space, particularly energy and crude oil. Worth noting, by the way, a lot of people, someone was asking about the narrative earlier today. How come airlines are doing so well with oil prices going up? And I would caution you, remember, that is a very simple narrative, thinking higher oil prices probably bad for airlines. Focus on the charts. Airlines are actually doing fine, even with higher oil prices. Finally, charts like this are a clear sign of flashing a clear warning sign. This could be the end of that pullback, and Facebook doubles from here. That's possible, but I think highly unlikely. I'm seeing deterioration specifically on the relative strength, which is what's concerning. Folks, that is our show for today. Thanks for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.